Over to you, Anna.
So most people have heard about having a growth mindset, which is the idea of wanting to grow, develop, change through hard work. And a money mindset is quite similar to that, actually. It applies to the same principles. It applies the same principles, but basically to finance. So it's what personal beliefs you have towards money and finances and what drives our behavior towards money, and allows us to change and adapt in order to reach our goals. So there's a bunch of important aspects in our lives that we might consider around money, and that's, are we savers or spenders? What kind of habits do we want to build around money? Do we want to remove any emotional triggers so that we can actually hit our goals instead of being reactionary? And also understanding our why. So why are we doing what we're doing? Is our goal financial independence, or is our goal to set our children up for a better future? Often kind of unpacking those personal beliefs will help us be better investors for the long term. And when I talk about the long term, having a long-term focus is really a part of that money mindset, because it's about habit building over a long period of time. There's no get rich quick schemes when it comes to investing. Well, there might be, but for very few people. So having a long-term focus is really important, which kind of brings me to the next slide. Long-term investing paired with a very diverse portfolio historically almost always outperforms the market. Whereas statistically, having short-term trades can actually hamper your returns. So I love hearing of these long-term focused stories, and you may have heard these before, but I'll share them nonetheless. Warren Buffett had a very famous bet that he made with a couple hedge fund managers on Wall Street, stating that the S&P 500 index fund will outperform hand-picked stocks of hedge fund managers. And over 10 years, surprise, surprise, guess who won? Warren Buffett did. And it was obvious that his focus on passive investing instead of active investing in the end was a better strategy. Similarly, he was quoted stating that once he passes away, that the trust in charge of his estate invests 90% of his money into the S&P 500 for his wife. So again, a long-term kind of focus in index funds specifically. And so when it comes to that long-term focus, and also being a bit more passive, Fidelity conducted an internal performance review of customers that they had, which had the best performing portfolios in 2003 to 2013. And what they found was the best performing portfolios were actually of people who have passed away or who are inactive investors. So again, not having a strategy, sticking to it, long-term passive is really a bit of a win. And that's something that we talk about at Perler quite a bit. It's not about being a casino. It's really on the long-term habit building that we do. Which brings me to consistency. And consistency is a huge part of that money mindset, right? We want to take out the emotional toll. So when we see the negative in our portfolio, that we don't freak out and think, hey, we should sell, or I should stop investing, or I'm going to wait till the market is better. All of those things are very reactionary. And again, talking about having a strategy in place that kind of keeps you consistent is really helpful. The concept of dollar cost averaging is a really important one. It's as people may have heard, it's about time in the market instead of timing the market. So the idea around dollar cost averaging is that you purchase your shares or ETFs or whatever it might be, regardless of if the market is up or down. So it allows you to, over time, have an average price that you've paid for your investment. This means that over that course of time, you haven't timed the market in terms of trying to get it at a cheaper price and so forth, but instead you're just doing it consistently. So you haven't missed any opportunities. And let's not forget the benefit of compounding and dividends over time. So just keeping consistent with that dollar cost averaging is really an important concept when it comes to consistency. Also, automation. A lot of people automate their bills. My credit card gets paid every month. Why not do the same for your investments? At Perler, we have one of the only platforms that you can actually invest and set up your investment strategy and not worry about it. So you can line it up with every paycheck or monthly, and just have it kind of work with whatever portfolio you want to invest in. And then similarly, roundup. So having some spare change that you want to continuously invest, you don't even notice it. It's just being consistent. You go out and pay for a coffee. It's, now in Melbourne, 9.80 or whatnot, that 20-cent difference, you can just put that aside and invest that and doing things like that actually kind of helps you with your own money mindset. It helps you focus on that long term. It doesn't let you be emotional, and it just kind of allows you to be a better long-term investor.